Thank you, Aman Agarwal and the Indian Institute of Finance for inviting to this International Research Conference and Awards Summit. And today I want to speak a bit about advances in behavioral economics and finance leadership. And it will be a very future-oriented presentation speaking about potential trends that will come out of this time. And it is actually parts of my newest book, which will be the second edition of Behavioral Economics and Finance Leadership, which came out in 2020 with Springer. So three large trends that I want to speak about today is, on the one hand, law and economics might get more attention in this interdisciplinary connection and in the disparate impact analysis in macroeconomics. In the post-COVID world, we will potentially see more attention of corporations on social justice and more of a decentralized organizing and forming of governance. And then to open it up on the global level, we might see more attention to climate change and something like a Green New Deal, but on a global level. And that might also help in redistributing some of the gains of climate change into areas that will definitely be losing on climate change. So these three trends I want to touch on. The first trend, I see that the connection of law and economics is vital and is going to be necessary to tackle a global macroeconomic shock like COVID-19 has been. It's the largest shock that hit humankind, and about 3% of the world GDP were shrunk by the first year when the crisis hit. But there was also this qualitative shift of some industries actually gaining from COVID-19. When you think about health, fintech, blockchain, big data, online retail, automotive, and design, whereas other industries really collapsed. And that really also led to a widening gap of inequality between the finance performance. Here we see, for instance, the S&P 500 as a market indicator has dropped first when the crisis hit, but then by August 2021, S&P 500 actually reached all-time high because the finance markets are able to exchange industries. Losing industries could be exchanged from portfolios for winning ones. Diversification is a strategy to avoid to be hit by losses. So you spread the risk by funding different industries, a broad range, and that's the way to avoid being hit by external shocks. But also hedging and shorting are potential financial market industry tools that could really feather the external shock, whereas the real economy really saw a liquidity crunch. In the real economy, also the low interest rate that helps finance markets to gain capital really also hit consumers psychologically. The low interest rate usually incentivizes consumers to live on credit, and if an additional external shock comes in and they lose a stable income, this is extraordinarily hard on the real economy. And then you can derive from other psychological, and here I'm in the behavioral economics literature, that potentially the finance world currently sees flows, control, and relaxation by gaining from an external shock, whereas in the real economy we might see more anxiety, worry, and apathy from this external shock. And here I tie it to the intro of the disparate impact. We already saw in 2020, Angus Deaton and Case brought out this book where they spoke about the disparate impact, that certain economic changes are extraordinarily hard on some parts of society, minorities, but also that they find that the middle class is extraordinarily pressured, and COVID-19 definitely has put another level to the pressures of the market. They call the book Death of Despairs, because they find that in the middle class, a lot of American male are doing drugs and are dying from despair, in suicide or drug consumption or extraordinarily risky behavior. Where you could also see this disparate impact on certain groups was the debate in the Markus Brunnemeyer's Markus Academy, where we saw the Larry Summers and Krugman debating whether or not the US governmental stimulus is going to be pushing too much inflation in the market. And here I'm back to Angus Deaton and Ann Case. Inflation also needs this vision. You have to really see where inflation hits harder, what parts of society will be hit harder, and really link it to the individual choices and aggregate outcomes. We can already now say if you're a homeowner, you're better off than if you are paying rent that is likely to rise. If you're living in cities, you potentially have a harder hit by when you spend a lot of your income on housing and food when you live in a city than in a rural area. And all these stratified inflation impacts really have to be deciphered, and here back again, deciphered not only to understand the economic impact, but that can be very disparate, but to really also understand what that means for governance and legal ways to really find the funds, but then also to distribute the funding in or the tax revenues with a vision that some parts of society might be hit harder by inflation than others. And overall, we will likely see more and more decision making whether or not the governmental aid that is there to alleviate the external shock of COVID-19 will be more a local, national, global, or future-oriented. Another disparate impact shade that I want to show you that is potentially more novel is, of course, we all know the coronavirus by now has hit the entire world. Over 220 territories are hit, and there are already now estimations that pretty much 80 to almost 100% of the world will have some touch point with the novel coronavirus. What is new is that almost up to 50% of the infected have longer term disabilities or problems, disabling conditions, and they are so-called long haulers, who it takes them simply longer for their bodies to recover after an infection, and that might be due to irreversible damage, remaining virus loads, or an overshooting immune activation. But here, to the disparate impact, we can say that about or over 70% of these long haulers are female, and they are usually medium aged in their 40s. And here again, a disparate impact analysis, what the COVID means on the long run. And here we need economists, but then how we can alleviate this burden, this pandemic within the pandemic, how we can alleviate calculate this will be the need to understand for governance and for law how you can find a solution for a female, for instance, to be protected at work, that they do not face so many customers or so many human touch points, that is likely to be seen in the future to come. Now, the second large trend is, I think that in a post-COVID-19 world, we are entering a new renaissance. We can already say that the actual renaissance sprung out in the Dark Ages after a global plague or pandemic of the 14th century. And this time, I think we will see a revolution more into e-health. We already now see an eco-wellness trend. People have moved out of large congested areas. In the US, for instance, only 8% of the full work population has returned to New York. And this trend also goes hand in hand with a lifestyle change. We see economics of rest and recovery booming. People like to live in harmony with nature, and medical revolutions are more looking into prevention, monitoring of tracking of your own body functions, and the tracking, for instance, whether or not you might face a high viral load. There's also this trend that this comes from the long haulers of democratization of healthcare information. We hear from the developing world when sometimes medication is missing, people are forming with groups, with online groups. They are forming networks of support themselves. And in the more developed world, so in the US and in Europe, you see a lot going on in Facebook groups where people start exchanging information about these new symptoms that COVID-19 brings that often can be very surprising. In the last trend, I want to open it more up and look at the global greening of the economy. As I said in the beginning, we have currently this unprecedented chance that we have all over the world springing out these help, rescue, and recovery funds. We have over 900 billion US dollars allocated for recovery in the US. In the European Green Deal, it should be 1.8 trillion euros, and those are the largest ever granted rescue and recovery packages that are focused on long term. So when we are about to embark on this new revolution, one large part of it is thinking about how to tackle climate change. And on a more global level, I propose in my research to look into redistribution mechanisms and thereby really look into novel ways how to redistribute the gains from a warming globe to areas that might be losing out. And I calculated as a macroeconomist here, I put a model together where I measure the countries by their mean temperatures, by their GDP composition, so agriculture, service, and industry are the three pillars of GDP that vary throughout the world. And then there's this peak temperature for productivity per GDP pillar. And I calculate when you have these factors, the mean temperature by country, the GDP composition by country, and the peak temperature for productivity per GDP sector, you can say that some countries have better conditions in climate change. They have a rising GDP prospect than others. And here in the world map, you see the greener the country, the more the country is expected to gain from climate change, whereas the red countries, they will have run out of time soon. And here in the bar charts, you see that the major part of the world in the downwards bar chart, you see the gains and the losses, and only a few countries will be gaining more from climate change than others will be losing. I already now find in a data set over the entire world that you do have the countries that have rising prospects also are polluting more in greenhouse gas emissions. They get climate-induced migration inflows, and they have financial inflows as well. So this is this uneven distribution of climate change gains also goes hand in hand with economic perks of more people, more funds towards that area. And I only show all these gains from a warming globe in order to make the case that we have to redistribute the funds. And here I calculate one model in which I factor in GDP per inhabitant, and you see the greener the country, the more the country should be paying into red countries that should be subsidized. I then also calculate some indices, and this is the last piece with what I want to leave you with. I did different indices, and just showing you briefly, for instance, here you can calculate together climate change gains and loss prospects and CO2 emissions, so who is causing it and who has gain prospects should be funding other countries. So here you see that China, colored in red, is more likely to fund a common climate solution into greener areas of the world that should be more recipients. And when you also factor in how climate flexible a country is, so how many temperature zones a country is, here again, China might have more of an obligation to pay into the greener countries. I also looked into who's changing CO2 emissions. Here, the US shifts more into a country that should be a beneficiary from payments, transfer payments in a redistribution scheme. When you also factor in historically grown bank lending rates, you can say that also China and the US have excellent conditions to raise funds, so they should be helping to transfer funds into the greener areas. And last but very important also, when you factor in consumption adjusted CO2 emissions, so when you factor in who is consuming CO2, who's buying goods that are produced in other countries, and historically grown bank lending rates. You can see here the red country, which is Switzerland, should be paying more into the greener areas of the world. And here also the effect shows that China is actually producing a lot of goods that are consumed all over the world. And with this, I thank very much for the attention and look forward to questions and answers.